there is no funding winter for good companies.
India is unique in the sense that it actually converts capital to revenue.
India is very well positioned for the next decade to drive global growth.
There certainly has never been a better time to invest in India.
Where is your firm focused right now? What kind of deals are you looking at? What kind of companies are you looking at? How many deals have you closed so far?
Oh, sure, actually. So I can't give you the exact number of deals we've actually closed, but last year we've invested close to 100 million cumulatively during the entire period from all the funds under management. Moment there is a winter or anything for that matter, it does actually become a buyer's market. So there are fantastic assets that are actually very well priced right about now that are actually available. So we made ample use of that opportunity. In fact, we actually raised and actually closed our fund within a quarter for this year itself. So there is active LP or larger investor interest in India. I think it's just about finding the fund managers who can find the right assets in their focus areas to end up actually investing. What we're seeing now is the India going global has actually become a very, very strong theme because of the likes of GIFT, etc. There are now regulatory avenues for people to end up going global from India without having to create a headquarters either in the US, Singapore, or anywhere else for that particular matter itself. And from a cross-border perspective, the use cases are contingent on just reducing the friction that's inherent in exporting from India, number one. And number two, with the internationalization of the India stack, as well as the digital public goods, any of the companies who can end up actually piggybacking upon that will have a first mover advantages in these particular areas. And the kind of restrictions you've seen on MDR and the like that apply in India should not actually end up applying when these particular protocols and standards actually go international. So we're looking at that as a very important emerging space from our side itself. The next thing we're seeing is from an EV perspective also, we've seen a large number of people, even though they are funding EV assets in terms of, I would say, new bikes, new cars and everything that's actually coming in. Mm-hmm. I think the fundamental technology and the entire shift that's happened over there is an area that's actually ripe for funding. We're seeing very, very strong projects that come out there, which are actually using non-rare earth metals when it actually comes to charging, when it does fast charging without corresponding battery degradation and the like itself. So that entire EV ecosystem that's actually built out now, even though I would say your battery swapping technology as well as your EV vehicles get a large amount of, I would say, news because they're more mature and it's something more tangible. The intangibles that actually go into that entire value chain is something that's actually very, very interesting to us.
So EV is one sector. I see a peaked interest from you in the EV sector. Yes. Where what are the other industries, the emerging areas where you think the investors will be focused?
I spoke about cross-border as well. I think the last thing that we're also seeing a lot right now is actually the building for Bharat. Now, building for Bharat, everyone looks at that and says, okay, what e-commerce worked in, let's say, a tier 1 city will end up working over there. What fintech applications worked in tier 1, tier 2 will end up working for that itself. I think the needs and aspirations of this class is actually far more bespoke and unique in this particular model. We invest in a company called Cuckoo.fm. They have close to 3 million paying subscribers from tier 3, tier 4 and the like itself.
Sure, yeah.
That actually shows that there is, if you can actually build a product that is something that can cater to them at a price point that is something that's also acceptable to them and where they see value for money, there is immense amount of purchasing power that actually exists within that long tail. I think too much of Indian VC has been focused on the top 100 million people within the country, English speaking, affluent, who end up actually, who are in business, who end up actually earning substantial amounts of money, vis-a-vis the rest. I think the unlocking the value that actually exists over here means actually remodeling your entire business, and there are some interesting entrepreneurs in that, and we're very happy to be part of those journeys.
But there's so much talk going around unit economics, achieving profitability, and then there is simultaneously there are talks that India is a price sensitive market. Customers really don't end up paying the price of all the services and products, if it's not need based per se. So I mean, do you see a challenge there? When you talk to the founders or building for a market like that?
No, I think a large amount of this is unfortunately groupthink and VC think for that matter. These are people who've actually gleaned these kind of information more from surveys and reports as opposed to actually speaking to people. Now, India on a purchasing power parity basis has actually crossed $2,000 on a per capita basis. So what that means is people have shifted from purchasing for subsistence to purchasing for, I would say, pleasure and privilege and the like itself. Yeah. That entire dramatic shift has already happened right now. The case in point of what I spoke about, the Cuckoo actually shows that if you can actually create products that cater to them, there are people who don't mind actually paying for that. Now, the biggest problem that we've often seen is there is this sort of mentality that what works in, let's say, a Bangalore actually works in like a Behrampur. Sure. It doesn't. There are miles apart within them, and they all
Yes.
have the unique legacies that apply. And you need to end up actually understanding the market a lot more as opposed to forcing the market to adopt to your kind of product. We've seen some of the early companies who come up over there have sort of forced, I would say, a model that would have worked in the US onto the average Indian consumer, and that's fundamentally failed. Indians do pay. We've seen the percentage of digital transactions, about 76% of India's
Yes.
GDP. Now that obviously shows that a large amount of this is actually happening online, and UPI is a large chunk of that. People do want to pay, but the problem is you're not giving them anything of value that they don't mind actually paying for. So what you believe may be of value to them, if the market doesn't resonate with that, is that a failure of the market? Is that your failure? I think we're now slowly learning the lesson that it's a failure of the market participants
I
and
was
not the
coming
market
to
alone.
that.
matter.
So should there be a re-strategization on part of
100%.
the founders,
100%.
following what has happened and
True.
the pivots to newer
It
models?
is. See, and the other thing is there are a large amount of businesses. What I call actually children of a low interest rate environment. They didn't have a fundamental business model that could actually end up generating money, and their business model was wholly contingent on raising larger and larger amounts of capital on a periodic basis.
Yes.
Because of rising interest rates, we've actually seen capital actually becoming scarcer. So all this lowering tide is actually helping people figure out who's been swimming naked and who actually has been. I for one, am very glad that unit economics is finally coming back to the forefront as opposed to GMV, only of these top line metrics, because ultimately these startups do have to become sustainable businesses by themselves.
Yes.
Now, some of them do have sustainable business models, but decide to aggressively invest into growth, aggressively lower discounts, etc. Look at e-pharmacy now. I think the 20-30% discount that used to exist previously is now actually gone. Everyone's actually selling it at MRP, and these companies have a better chance of turning profitable that way. I think the venture subsidy that underpinned a large amount of the Indian startup ecosystem in the last decade is slowly actually going away. They're now saying that we no longer have to incentivize people by giving lower prices to actually come and patronize our businesses. Our business should have the ability to actually stand alone, and the product or service by itself should be able to command the kind of price that it needs. If there's a problem with the pricing and the price structure and you can't enjoy your margins there, you either have to convince the customer to end up paying that particular amount or lower your cost structure. We've seen Indian startups unfortunately suffer a large amount by over-investing into their own processes, and their own corporate balance sheet bloat is so large. Even if the business is unit economic positive, they'll never actually turn net profitable because there's so much bloat that's actually built into it. So what used to be lean has now suddenly become gargantuan. And they have to unlearn a large amount of this and end up actually looking at building businesses that are far more sustainable. The valuation will follow. If you noticed, even though we've seen the lowest amount of capital going into Indian startups over the last 2 years, we've seen the highest amount of dry powder actually build up. There's close to $60 to $70 billion of dry powder looking at India alone.
So you're talking about the domestic capital right now.
Domestic capital and foreign capital as well. Okay. There is, like I said, we closed out our fund within a span of a quarter itself.
Yes.
We were actually very, very fortunate to end up actually being able to do that. But look at the year 2022, a large number of fund managers actually did end up raising their funds, but there have been no corresponding investments made by them. So that's what I mean by dry powder. There's the LP market or investors into fund managers. There's the fund managers in the VC funds. Then there are the portfolio companies. This leg of the transaction has seen the highest volume of activity. New funds have been raised, large amounts have been raised. None of it's actually been deployed over here. So it's more a question of the VCs getting more comfortable with this new emerging paradigm, as well as a high interest rate environment where your next rounds are no longer contingent on meeting one or two business metrics. It's actually about becoming and building a more sustainable business. So VCs are now changing their entire playbook, saying, not telling the companies, look at these 3 metrics you'll raise around, but look, build a business that actually works. It's relearning for them also. And we, for one, are glad because what we used to espouse from the day we actually started off is now actually becoming more widely accepted by the market. And that gives us an inherent advantage and a company's inherent advantage because you already inculcated that into their DNA from day one itself.
Sure. So the era of easy money is over, like you pointed out earlier, right? So tell us something about, the valuation markdowns, which you said, right?
Yeah.
So we've seen some of the biggest unicorns in India already, facing this valuation markdowns and all. So do you think that is a price correction, or what is your take on that? I mean, will that have an impact on the overall
100%.
ecosystem?
So I'll actually break this into two pieces. Number one is, you need to understand that your valuation is not static. In the unlisted space and for startups, they've sort of gotten used to this fallacy that once I reach a 1 billion, 2 billion valuation, I will remain at that valuation for 1-2 years until I raise a subsequent round of funding. Whereas look at the listed market. A company may reach 1 trillion and one day may end up actually going down to 800 billion. Somebody may reach 20,000 crores, go down to 15,000 crores. We've seen massive dislocations happen in a very short span of time. So one major issue is everyone believed their market valuations were static. So there's an anchoring bias that's actually created, right? They don't want to raise below that. Obviously, there are the covenants and all in their investing documents that may have consequences for that. But from a market perspective, we need money to end up continuing a business. You're not going to be too choosy about the terms. So I think that's one important element. The second thing that we also need to differentiate is real markdowns versus accounting markdowns. Now, what do I mean by that? A real markdown happens is when an external investor or a third-party investor actually gives a price to the company and the company accepts that particular price.
Yes.
There's obviously consensus that built in and said, this is the new valuation. There's consensus amongst all of us. This is the new normal. Full stop. What we've seen in the ecosystem so far, that's been what I call accounting markdowns. Now, if you look at the accounting standards that apply to a VC fund, to a hedge fund, to a private equity fund, anyone for that matter, all of them actually talk about mark-to-market accounting. What does that mean? My balance sheet has to reflect the true and accurate value of my investment at that particular date. So every quarter end, I look at, is this, if I'm carrying the value, let's say 100, is it really worth 100? Can I achieve 100% in the market? Or do I have to mark it down to 70 or 80? These are driven by regulation. These are driven by risk management policies of investors, which is why even in several large Indian unicorns, you see no two investors have agreed on the degree of markdown. So these are bespoke to that particular investor for that matter. And these are not a real reflection on the true value of that company, because it's very hard to get two investors to agree on the value of a company for that matter. And the only way to validate the value of a company is if someone's willing to actually cut a check at that valuation and the company is willing to actually accept that money. What we've seen happen in the Indian ecosystem as of now, we've raised the highest amount of money in the year 2020 and the year 2021. Now, obviously, because these companies have undergone substantial cost reduction measures over time, none of them need to end up going and raising money. The terms are unfavorable. They don't have to step out to the market. They have enough internal accruals. They have enough larger amounts of cash with them on their balance sheet that can extend runway for a substantial period of time. So we've not yet seen the kind of real money markdowns the way we actually have. We haven't seen a down round happen. We've seen markdowns that happen which are more a casualty of the policies of that particular investor as opposed to the ground realities of that particular business for that matter. But unless we see actual down rounds, that's when we realize we're actually reaching the bottom.
It's interesting you're saying that there is basically dry powder available, there is capital available, but then we see the reports of like Dunzo, for instance, trying to stay afloat. Dunzo, which was, promoted as the flag bearer of quick commerce, logistics, everything. So much traction 2 years before, and right now facing the squeeze, which has a bearing on the employees. So, I mean, what should these companies, even Byju's for that matter, it is in the middle of so many challenges, and these were the flag bearers of Indian startup ecosystem. So, do you think that, how long are the bad times going to stay for them?
I think the bad times are going to last until the end of this year, if you actually ask me, because I think by the end of this year, there are two important factors that are going to converge. Number one, the amount of money that these companies have on the balance sheet will end up dwindling, forcing them to end up going to the market and accept whatever valuation the market gives them. I think the second thing we're going to see is the large amount of dry powder I spoke about. That's actually just sitting on the balance sheet and bank accounts of these VCs and fund managers is going to actually start dragging upon them to a large extent. Most of the funds, it's an open secret in the fund world, but they end up raising money on a sort of periodic cadence. So every 2.5, 3 years, they go and raise a certain fund of a certain size, and they end up actually doing that. Now, it's very hard for them to break that cadence. If you raise in 2021, you should be raising your next fund by about 2024. But we're already in 2023 now, and if you haven't invested, the question is going to come from investors, from their investors, is if you have so much dry powder and haven't actually invested, why should you raise another fund?
Yes.
It will dislocate everything. So there will be immense amount of pressure on them for them to end up actually making those kind of investments. So we're going to see these two factors actually operate neck and neck. And which one's going to give out first is something the markets yet to actually figure out for that matter. And with regard to the companies you spoke about, now, I think an important part to also understand is most of these guys, their capital allocation, I think, was actually contingent on low interest rates and contingent on if I hit these metrics, I will raise my next round. Now, when that rationale got undone, it's a fundamental rethink of their entire businesses for that matter. Even look at Dunzo. Dunzo's trying to raise now. There's only rumors of Zepto actually raising a large amount of money itself.
Yes.
So I think it's more a mark of investor confidence. There are investors who agree that certain business models are worth pursuing. There are investors who may not agree with management style to certain about running the particular business, and they end up voting with their wallet, which I think is important. So I don't see this as a negative. I see this as a learning opportunity for them to understand that, look, the good times will always come to an end.
So do you believe that the era of quick commerce is over. Do you think about, are we seeing a slowdown in quick commerce
We
right
are.
now?
See, quick commerce also, I don't think a 10-minute delivery or a 20-minute delivery is actually the kind of innovation people want. There are very few SKUs where you actually need that kind of quickness or that kind of agility to end up actually feeding you for that matter. Right. And the thing is, your total market who doesn't mind paying a premium for that kind of speed is much smaller than the overall market that ends up actually using quick commerce
Sure.
and hyperlocal to a large extent. The problem that these people have been trying to face right now is the problem of pricing. How can I end up pricing my service such that I can cater to the needs of the customer and end up actually making money? So many of people I know have actually bought a 10 or 20 rupee item using a quick commerce app because there's no delivery fee. You can't run a business with no delivery fee for that matter. There isn't high enough margins in these particular SKUs that they're buying for them to end up actually doing that. So quick commerce, I think, quick commerce is going to see the most rapid change in their business model and in their pricing compared to
Not
everyone
dead,
else.
but won't be dead.
Won't be dead. See, it's become a matter of convenience. Even a lot of people said, you know what, Uber and Ola are going to die, etc. Even though they haven't raised in a long period of time, they're still running. They become large businesses. Even though prices have gone up,
Yes.
now it's actually reflecting the cost of actually servicing the customer. I think what we've seen is capital has ended up distorting the true cost of rendering services or actually selling products,
Yeah.
and that distortion is slowly actually going away to a large extent. It's also causing inflation because the people taking that hit were actually investors
Yes.
for that particular matter.
But wouldn't that be the end consumer now? I mean,
Now it would be the end consumer, because I think what we want to see, the artificial distortion of prices have actually negatively affected earnings of these companies also. So now the choice between either survival as a business or subsidizing the customer, more businesses are choosing to actually prioritize survival as opposed to subsidy, which I think is important. I think we've seen in this country, especially, we've had large amount of debates about subsidy and the quality of subsidies.
Yeah.
I think that debate's now being had at boardrooms of startups also, in addition to parliament and the like itself.
So I would want to ask you one question. I know you've been advocating about the abolishment of angel tax. I know you're against the whole idea of the introduction of angel tax and several provisions under it. Are you in touch with with the ministry, with the finance ministry, from the investors community? Are you actively talking to the investors also that how is basically this an impediment to the inflow of money from outside India?
So I think it's an entire ecosystem. We've actually, the moment this was announced, obviously in the budget, it caught the entire ecosystem by surprise. As an ecosystem, we've always been advocating for the fact that we need to have parity between foreign investors and domestic investors. We're looking at parity in terms of if they have something good, give us the same thing itself.
Sure.
If you look at parity as something that negatively affects us, it will also end up negatively affecting them. If you look at the startup ecosystem also, close to 85% of the capital coming in actually comes from foreign sources. Now, the reason why angel tax was called angel tax is because Indian investors or rupee capital was predominant in the early stage. And it's only their investments that end up actually getting caught in this web. So up to Series A, you would have a preponderance of family offices, smaller corporate outfits, MSMEs, individuals, HNIs, etc., end up actually making those investments. As the company reaches Series A and onwards, the investors coming in are your global investors, private equity funds, venture capital funds, growth stage funds, mid-stage funds, etc. So angel tax never applied. Now, by the change that the government has proposed, the entire capital stack investing into India now comes under the ambit of angel tax, except for AIFs in GIFT, as well as AIFs regulated by SEBI. So that's a very narrow margin, a very narrow piece of the overall funding that ends up actually happening. And it takes a long period of time for investors to pivot and change their model. If you look at the regulations that have come up now over the safe harbor countries, which is your US and the like itself, 3 out of the top 5 largest providers of capital to India are actually missing. If you look at the RBI annual report in 2021, 22 and 22-23, Netherlands, US, with Cayman Islands, Singapore and Mauritius. All of them are actually part of that. They are the top 5, giving in 76 to 76.5% of total FDI into the nation. Out of these countries, it's only the US that's a safe harbor country. The rest of them are not. So the substantial amount of uncertainty that's been created is severely problematic. Now, even though the tax department has said that, look, we're not going to look at only book value or DCF, your discounted cash flow. We will look at a whole range of valuation methodologies. The problem has never been a valuation methodology. The problem has been the way the tax department has actually scrutinized these transactions. What the tax department does, and it's a fairly open secret, is that the tax department actually gets a copy of your valuation report, which talks about your future projections and what you want to end up doing, looks at your actual performance, and then does a compare. Now, the moment the deviation is significant, according to significantly more than 10% or anything for that matter, then they say your valuation report is bunkum. We will not accept a valuation report. We will just tax the entire amount as money. Now, if you look at it, if I raise money in 2020, just let's say in February 2020, I would have lost a large amount of time because I was unable to operate my business because of lockdowns. Now, obviously, that means I would never actually meet my projections. Now, does that actually mean that the source of capital is tainted? The problem with angel tax is it converts a capital receipt, which is an investment, into revenue. India is unique in the sense that it actually converts capital to revenue in this particular fashion. Normally, you only convert gains. But they've actually converted capital flows. And very few investors want to take the risk of actually investing into a company where they know that 25% of their money can end up actually going to the tax department because of these kind of operational friction. Now, there is a rationale why angel tax was actually came about. There were noted cases by the department about these kind of distortions and the like itself. But the problem that started happening as of now is that the misapplication of this law on genuine transactions, the problem. If you look at even Mauritius and Singapore, the largest sources of their FDI is actually the US and the companies on that list. Now, if I'm a US investor comes in from Singapore into India, I'm still a US investor. It's still my money, but it's coming through another jurisdiction. Why should, if I came in directly to India, I would not be subject to angel tax? Why should my investment coming through Singapore be subject to angel tax? Is the question. So by doing this, we've essentially taken a massive step back. If the aim of this is to actually prevent people from abusing the regulation, rather than actually going after the entire industry, why don't they actually create a set of safeguards if a company wants to be compliant and the company has nothing to hide? Adopt these particular safeguards, that dematerialization of securities, giving details about your UBO, which anyway a financial institution has to, making sure all your transactions happen through a proper wire transfer, doing your proper due diligence in terms of AML, counterterrorism financing, etc., on your investors. These are normal stuff that a financial institution has to do. Now, if a startup was willing to adopt those standards, it's to stand to reason that the startup has nothing to hide. So hence, move them out of angel tax. Rather than keeping this law the way it is as of now, which applies to almost everyone for that matter, that uncertainty is actually dragging upon investors' expectations who are investing in India. And this angel tax provision, unfortunately, will actually see a large number of entrepreneurs say, I'd rather set up my holding company in Singapore or the US where these provisions don't exist, as opposed to doing it in India. So even though we've had GIFT IFSC recently constituted a committee about onshoring Indian innovation, about getting companies who flipped overseas to come back. But in parallel, the government's actually created an active incentive for founders to actually shift their base overseas. So it's two different things that are actually happening. So it's like a mix. It's a mixed message that's actually going about. So angel tax has forever been a bugbear. I think the entire industry knows for a fact that this regulation won't go away. But rather than the current approach of painting everyone by the same brush, create a higher degree of compliance such that willing people who have nothing to hide and are running genuine businesses can end up adhering to these higher standards and allow them to be exempt from the provisions. If someone has something to hide and doesn't want to adhere to higher standards of transparency and governance, by all means go after them. That's a stronger indicator of something going wrong, as opposed to misapplying the resources of the tax department on genuine transactions whose only problem is that their performance never actually met their projection. That's a business dislocation. It's not a regulatory dislocation.
Thank you so much. Thank you, Siddharth.